Let's learn finance and manage your finance yourselves. Hey, have you ever heard words like revenue, EBITDA, profit after tax, or margins and thought, what does that actually mean? Thinking face well, you're in the right place. In just 6 minutes, we're going to break it all down, nice and simple. So, let's dive in. First up, let's talk about revenue. Revenue is the total amount of money a company earns from selling its products or services. Think of it as all the cash flowing into the business before we deduct any expenses. Revenue equals price x quantity sold. Easy, right? But wait, just because a company makes a lot of revenue doesn't mean it's super profitable. That's where expenses come into play. Now, let's move on to something a little trickier. EBITDA. This stands for earnings before interest, taxes, depreciation, and amortization. But don't worry, it's simpler than it sounds. Imagine you want to find out how much money your business earns from its core operations, before you account for things like loan payments, taxes, or the aging of your equipment. That's what EBITDA measures. Revenue operating costs, like rent, salaries, and raw materials, equals EBITDA. Think of it as a way to measure the operating health of a company. A high EBITDA means a company is running efficiently and making good money from its main business, profit after tax, PAT. Alright, now let's talk about profit after tax, or PAT. This is the actual profit left in a company's pocket after paying for everything: operating costs, interest on loans, taxes, and even depreciation. Think of it as the bottom line or the true profit the company makes. In short, PAT tells us how much money the business truly keeps at the end of the day. Lastly, let's cover margins. They help us understand how much profit a company makes from its revenue. If your lemonade stand earns $100 in revenue and $20 is left as profit, your profit margin is 20%. Profit margin equals profit divided by revenue, x 100. Margins are super useful because they let us compare companies, no matter their size. A company with higher margins is usually more efficient and profitable. Revenue. Total money earned. EBITDA. Profit from core operations. PAT. Final profit after all expenses. Margins. Profit as a percentage of revenue. So, to recap, revenue is all the money coming in. EBITDA shows how efficiently the business operates. PAT is the final profit after paying everything. And margins help us see how profitable a business is, in percentage terms. Hit the thumbs up, subscribe for more bite-sized business tips, and comment below if there's a topic you'd like us to cover.